global factors like inflation and supply chain bottlenecks over the COVID time period have trickled into the Colorado Springs market. We saw a ton of new builds while rates were low, at least new build starts. Those kind of have fully come to the market, and that's why we haven't really seen rents increase like you might expect, because a lot of that supply was in the smaller, lower priced point, like apartment style space. But in the last couple of years, while rates have been high, we haven't seen as much new build starts. And what that means is starting about now-ish, we're probably going to see home prices just be buoyed by that and maybe even grow a little bit as the cost of the inputs and also labor with the whole immigration policy that we're going through right now affects new construction. It'll be a decrease or a limitation on the supply, and as rates continue to drop, as we're seeing, that increase of demand is probably going to push prices maybe up a little bit. So I would expect just pricing to be a little bit flat for the next year or so, but then start to climb again. Maybe not crazy climbs like we saw in COVID, but that limited supply does keep prices a little bit more elevated. Yeah, not a big impact to Colorado Springs. We're not considered one of the primary metro markets like Denver or LA, New York, Miami. So those foreign investments are generally at the higher price home prices in luxury markets, metro areas. So in Colorado Springs, we haven't seen a big impact from the foreign investment rules and restrictions. Yeah, I would say if you're in Florida or California, where wildfires and floods have bigger impacts, hurricanes, that kind of thing, those markets are seeing more of the impacts. Colorado Springs, yes, we've got hail. That is our biggest weather impact, and that does drive insurance costs up. But compared to CPI or just regular inflation, insurance hasn't been as huge of an impact in our market. It is still a concern for many folks that are seeing their monthly mortgage payments going up as a result of the insurance increasing, along with their property values that push taxes up. So it does shape the buyers' decisions, and that's why I always like to tabs on what the insurance rates are like out here, so that when we're estimating payments, we can be as accurate as possible. If I know that the roof is over 10 years old, for instance, I know that there's going to be a higher premium on your insurance, and that's something we can forecast a little bit ahead of time. So you're not walking into a situation where, before you go under contract you're low, and then all of a sudden you're surprised by higher estimates after. So just one of those things that you really got to take property by property and take into your affordability calculations. Depends who we're talking about. A lot of first-time home buyers, they take a wait-and-see kind of approach to global instability. They figure, I don't really know, do I want to hold on to or acquire an asset that's going to be, there's got a large debt component to it. But investors, if you've got that mindset, and even the first-time home buyers who are thinking that way, do see it as a safe haven. As the component costs or the building costs go up, home prices go up. And so if you're seeing instability in the global market, that actually probably means that real estate's going to be a better hedge or a place to put your dollars than somewhere like stocks, where generally instability and volatility will decrease the value of a stock. Real estate tends to hold its value a lot more. So I'm of the mindset, I think you should buy during times of instability, just because real estate is a good place to hold your money. I would rather have something that's inflation protected than something volatile that could, in a day go down 50%. Real estate's not going to do that. Yeah, the next 1 to 2 years, there's a lot of questions about what's going on with tariffs. How do those affect interest rates? If interest rates stay high, I think real estate is going to stay relatively flat. which, depends what phase of your investing career or, your purchase timeline you're looking at. If right now you're looking to acquire or buy a property in the next couple of years, I think it's great because there's less competition for those houses. If you're hoping for the asset appreciation that you saw during COVID, probably not going to happen over the next 2 years. Another thing that I'm thinking about is rising insurance costs, decreased labor in the construction market. What do foreign entanglements or conflicts in foreign countries, what do those do to just the general desire for builders to build? They don't like uncertainty. Generally, they tend to hold back. So if you're looking at the supply demand side, there are just so many factors. At the end of the day, I like to just dollar cost average into real estate. I don't think there's a good argument for trying to time the market because you just never know what's going to happen. So marry the house, date the rate. Eventually, if rates get better, refi into a lower rate. It's a good time actually to buy is over the next 1 to 2 years.